Hello, future smart investors. Welcome to our journey into the stock market. Many people think investing is like gambling. They believe you just pick a stock and hope for the best. That's not true. It is a skill. It is a science. It is something you can learn, step by step. Like not buying a house without checking the foundation. Don't buy a stock without checking the company's health. This guide gives you the tools to do that. Imagine a busy fruit market. You want the best, juiciest mangoes. You don't grab the first one you see. You look at its color. You feel its firmness. You smell it to check for sweetness. You're analyzing the mango before buying. Analyzing a stock is the same, checking a company's health. We use special tools called financial ratios. These ratios show performance. They show strength. They show potential for future growth. Think of them as your magnifying glass for inspecting stocks. It helps you move from speculator to investor. A speculator hopes for quick profit from rumors or price moves. An investor makes decisions from solid facts and deep understanding. Learn analysis and take control of your financial future. In the Indian stock market with thousands listed, this skill matters. It helps you find hidden gems. It helps you avoid companies that might lose you money. Ready to begin this exciting adventure? Our goal: demystify stock analysis. We'll break complex ideas into easy pieces. You don't need a finance degree to succeed. You need curiosity, patience, the right knowledge. We'll show exact methods pros use, using real examples from well-known Indian companies. By the end, you'll confidently read financial reports. Let's get started. Become a more intelligent, confident investor in the Indian market. So, what exactly is this powerful tool called fundamental analysis? In simple terms, it is the method of determining a stock's real or fair market value. Sometimes a stock is overvalued, meaning it is too expensive. Other times it might be undervalued, meaning it is a bargain waiting to be discovered. Think of yourself as a detective. A company's stock is your case. Clues are in the company's financial statements, balance sheet, profit and loss statement, cash flow statement, because a company's stock price, in the long run, will always follow its fundamental performance. Now, let's talk about the main weapon in your fundamental analysis arsenal: financial ratios. For example, we can compare a company's profit to its revenue. This gives us a ratio, the profit margin, which is 10%. Think of a doctor checking your health. They don't just look at one number. Imagine you want to compare two banks in India, say HDFC Bank and ICICI Bank. HDFC Bank is much larger than ICICI Bank in terms of its total business. But if we use ratios, like the net profit margin, ratios standardize the information, allowing for a fair apples-to-apples comparison. Our first profitability ratio is the net profit margin, or NPM. It tells you the ultimate story of a company's profitability. The formula looks like this: net profit margin equals net profit divided by total revenue, multiplied by 100. Let's take a real example from the Indian market. We will look at Infosys, a leader in the Indian IT industry. For the financial year ending March 2024, Infosys reported a total revenue of approximately 1,53,670 crores. Its net profit was about 26,233 crores. The calculation gives us an NPM of approximately 17.07%. For instance, if we look at its competitor, Tata Consultancy Services, their NPM was around 19.3%. This simple comparison tells us that while Infosys is very profitable, TCS was slightly more efficient in that particular year. Next up is another powerhouse profitability ratio: return on equity, or ROE. It measures how effectively management uses shareholders' money to generate profits. The formula is simple: net profit, shareholders' equity x 100%. This time, we will look at HDFC Bank. HDFC Bank reported a net profit of approximately 64,060 crores. Its total shareholders' equity was around 4,08,180 crores. This calculation gives us an ROE of about 15.69%. However, we must use ROE with a little bit of caution. A company can artificially increase its ROE by taking on a lot of debt. Our final profitability metric for this section is earnings per share, or EPS. In the simplest terms, it's the profit that belongs to you for each share you own. The formula is EPS equals net profit minus preferred dividends, divided by the total number of outstanding shares. Its net profit for the year ending March 2024 was 26,233 crores. Infosys had approximately 415 crore shares outstanding. This gives us an EPS of approximately 63.2 per share. What matters more is the trend of EPS over time. An increasing EPS trend is a powerful signal of a business becoming more profitable. A company can be profitable on paper, but still get into big trouble if it cannot pay its bills on time. This is where liquidity ratios come into the picture. These are the bills that are due within the next year. Payments to suppliers, short-term loans, employee salaries. Imagine a friend with a very high salary who is always borrowing money from you at month end. He is profitable, but not liquid. Companies face the same issue. They might have large factories, expensive machinery, but they still need cash for day-to-day expenses. Our first and most widely used liquidity ratio is the current ratio. It tells us how many rupees of current assets a company has for every 1 rupee of current liabilities. Asian Paints had total current assets of approximately 16,770 crore rupees. Its total current liabilities were around 10,480 crore rupees. This gives us a current ratio of approximately 1.60. Now, let's move to a more conservative liquidity measure, the quick ratio. It gives a more stringent test, without relying on inventory. As of March 2024, Tata Motors had total current assets of about 1,88,886 crore rupees. Its inventory was approximately 71,780 crore rupees. Its total current liabilities stood at around 1,97,450 crore rupees. Quick ratio 0.59. Now, we need to zoom out and look at the bigger picture. Assess a company's long-term financial health. This is where solvency ratios come into play. Think of a person buying a house with a home loan. Solvency is about surviving for many years to come. Solvency ratios help us measure how much a company relies on borrowed money. This is also known as its leverage. Let's start with the most famous solvency ratio of them all, the debt-to-equity ratio. As of March 2024, total borrowings were approximately 3,24,642 crore rupees. Total shareholders' equity was about 10,61,668 crore rupees. That equals approximately 0.31. This ratio measures a company's ability to make its interest payments on its outstanding debt using its operating profits. RIL's earnings before interest and tax was approximately 1,64,379 crores. Its finance costs were around 23,178 crores. This gives us an ICR of approximately 7.09. A great company is not a great investment if you pay too much for it. This is where valuation ratios come in. They connect the company's stock price with its underlying financial performance and value. Let's begin with the king of all valuation ratios, the price-to-earnings ratio, or PE ratio. It tells us how much the market is willing to pay today for every 1 rupee of a company's current earnings. As of May 24, 2024, the stock price of TCS was approximately 3,800 rupees per share. For the financial year ending March 2024, TCS reported a consolidated EPS of around 129 rupees. This gives us a PE ratio of approximately 29.5. Our next valuation tool is the price-to-book ratio. It is the value that would be left for shareholders if the company were to be liquidated today. As of March 2024, HUL's total shareholders' equity was approximately Rs 51 878 crore. The book value per share is about Rs 220.7 per share. As of 24th May 2024, the stock price of HUL was around Rs 2,350. This gives us a PB ratio of approximately 10.6. HUL's main assets are not factories or machinery, but its powerful brands. These intangible assets are not fully reflected in the book value. Our final valuation metric is called the dividend yield. It tells us how much cash you can expect back each year for holding the stock. For the financial year 2023-24, TCS declared a total dividend of 73 rupees per share. Its stock price was around 3,800 rupees. This gives us a dividend yield of approximately 1.92%. We will add the final piece to our analytical puzzle by looking at efficiency ratios. They measure how well a company is utilizing its assets to generate sales. Our first efficiency ratio is the asset turnover ratio. This is a powerful metric that measures how efficiently a company uses its total assets to generate revenue. FY ending March 2024, total revenue 1 to 40,064 crores, average total assets 1 to 36,441.5 crores. Asset turnover, sure as 1 to 40,664, 1 to 36,441.5, falls to 1.03. Next, let's look at the inventory turnover ratio. This ratio measures how many times a company has sold and replaced its inventory over a specific period. Nestlé India's cost of goods sold was approximately 9,050 crores. Average inventory comes to 2,305 crores. This gives us a ratio of approximately 3.93. The true power of ratio analysis lies in combining these different metrics to weave a coherent and comprehensive story about a company. For example, you find a company with a very high return on equity. But before you get excited, you must check its debt-to-equity ratio. A company with a high return on equity and low debt, however, is a true gem. The real skill is in seeing how the ratios interact. Your goal is to build a 360-degree view of the business. One of the most common mistakes is analyzing a ratio in isolation. Another major trap is relying on a single year's data. Always use the numbers from the official audited financial statements. You must supplement your quantitative ratio analysis with qualitative analysis. Ratios tell you what happened. Qualitative analysis helps you understand why and what might happen next. We have reached the end of this guide, but we are at the very beginning of your exciting journey as an informed investor. Start small. Pick a company you know and admire. Go to its website, download its latest annual report, and try to calculate a few of the ratios we have discussed. See what story the numbers tell you. The time for passive observing is over. It is time to roll up your sleeves, open an annual report, and start analyzing. The stock market is ready to reward those who do their homework. Take this first step today and begin your journey towards achieving your financial goals. Happy investing!